Welcome to Breaking News to Trading Moves. We're looking today at a potential policy change, something that could really stir things up for tech staffing and IP services here in the U.S.
Yeah, the headline here is a proposal for a pretty significant fee on H-1B visas. We're talking $100,000 per year per visa in certain categories. And this isn't like a small tweak. It's a really substantial increase in the cost of bringing skilled foreign workers into U.S. operations.
Right. So our mission for you, the listener, is to get a handle on the likely market reaction, who's expected to benefit, who might lose out, and what's the thinking behind those projections.
Exactly. It's about the immediate economic logic. You make one route for talent acquisition that much more expensive.
And companies start looking for alternatives almost overnight.
Precisely. The analysis points towards companies that offer U.S. domestic talent or those enabling remote work, offshore work, basically anyone providing a more cost-effective option now.
Okay, let's dig into that. Let's start with the winners, the ones whose services suddenly look, well, a lot more appealing if that $100,000 fee comes into play. First up, domestic staffing.
Makes sense. Look at Robert Half International, that's ticker RHI. For a long time, the H-1B was often the go-to for specialized tech roles, partly because of cost. But add a $100,000 annual fee on top, suddenly hiring a domestic contractor seems much more economical.
So RHI wins because companies will likely try to avoid that big visa fee and look for U.S.-based contractors instead.
That's the projection. More demand for domestic tech talent, contract placements, firms actively trying to sidestep the cost and, frankly, the hassle of the visa process if it gets that expensive.
Okay, that tracks. What about ManpowerGroup, ticker MNS? Similar dynamic.
Similar, yeah, but maybe leaning more towards longer-term roles. Think temporary to permanent. Companies might hesitate to commit to that $100K fee right away for a permanent hire,
Sure.
So they could use ManpowerGroup to bring someone in on a temporary basis.
Test them out.
Exactly. Test the fit, see how it goes, and then maybe convert them to a permanent employee, all without that initial H-1B cost burden. It's a pivot away from relying so heavily on those visa-dependent models.
It's fascinating how a cost change like this flips the script. Domestic labor, maybe once seen as pricier, now becomes the safer, more predictable bet. But it's not just about hiring within the U.S. borders, is it? Remote work platforms seem poised to gain too. Upwork, UPWK.
Oh, absolutely. This is almost pure math, isn't it? If getting someone physically into the U.S. on an H-1B costs an extra $100,000 a year, well, suddenly outsourcing tasks or hiring remote contractors through a platform like Upwork looks incredibly cost-effective in comparison.
Especially for work that doesn't absolutely need someone sitting in a U.S. office.
Right, that cost difference could drive a lot more activity to their marketplace. Cheaper, faster, less paperwork.
Okay, so we have domestic staffing, remote platforms. What about firms that manage big projects but maybe not entirely onshore? You mentioned offshore alternatives. Globant, GLOB, comes up here.
Yeah, Globant's model is interesting. They focus a lot on nearshore delivery. So think teams in Latin America, for instance.
Similar time zones, easier communication than, say, halfway across the world.
That's the idea. And when the cost of having that H-1B worker in the U.S. jumps... It's a really significant cost advantage. They can offer that proximity, that collaboration, without the huge visa overhead that onshore H-1B reliant teams would now face.
So the alternatives seem clear. Go domestic, go remote, or go near shore. But that still leaves the underlying issue, right? The actual need for skilled STEM workers.
That's a crucial point. This brings us to another potential winner category, addressing the longer-term pipeline. Education and upskilling.
If bringing in talent gets much harder and more expensive,
then the logical move for companies is to invest more in developing the talent they already have or can hire domestically.
Which points towards platforms like Coursera, ticker COUR.
Exactly. The thinking is with H-1B visas becoming so pricey and maybe harder to get, companies will have a much stronger incentive to expand their internal training, upskilling, reskilling programs. Why pay a $100,000 fee for one visa if, for a fraction of that, you could invest in training programs for, dozens or hundreds of your current U.S. employees to fill those STEM gaps?
It shifts the investment calculation towards building talent internally.
Right. It becomes a strategic move. Invest in your domestic workforce, build that pipeline yourself, rather than relying on an increasingly expensive and perhaps uncertain visa process.
Okay, that covers the potential winners. Now let's flip the coin. Who gets squeezed by this? Which companies have business models that are really exposed to this kind of fee increase?
Well, the analysis points pretty clearly to the large IT services and consulting firms, particularly those historically headquartered outside the U.S. that have relied heavily on bringing H-1B workers onshore for client projects.
Their whole model was often built on that cost difference, right?
Yeah.
Leveraging lower global wages and bringing workers to the U.S.
Precisely. That cost arbitrage was key. The $100,000 fee directly attacks that model. It puts immediate, serious pressure on their margins.
Okay, let's name names. Cognizant Technology Solutions, CTSH. How does it hit them?
For a company like Cognizant, which relies significantly on H-1B employees for U.S. projects, this is a direct hit to profitability. Think about existing contracts. If they bid a project assuming a certain labor cost based on H-1B workers, and suddenly that cost per worker jumps by $100,000.
But the client contract price is fixed.
They have to eat that difference, that $5 million you mentioned earlier for 50 workers. That comes straight out of their profit on that project. It messes up the economics of work already underway.
Ouch. So can't they just raise prices for new work or try to renegotiate?
They can try, but that's where the competitive pressure comes in. Look at Infosys, INFY. Similar reliance on H-1B staffing for U.S. operations. Yes, their operational costs go up. But if they try to pass that full $100K increase onto clients in the form of higher rates.
The clients now have those other options we talked about, Robert Half, Upwork, Globant.
Exactly. The client can say, wait a minute, why would I pay you this massive premium when I can get a domestic contractor for less or move the work near shore? They lose their pricing power.
So it's a double whammy, higher internal costs and less ability to pass those costs on.
Definitely. Client pushback becomes a major risk. These alternatives suddenly look much more attractive.
And finally, Wipro, WIT, same boat.
Very similar exposure, yes. High dependence on H-1B staffing for their U.S. projects. For them, this increased cost structure just makes their traditional onshore delivery model much less viable. They might be forced to try and shift more work offshore, even if the client preferred an onshore presence, or risk project delays, or simply not be competitive on bids for new onshore work. It really puts pressure on their whole U.S. strategy.
Okay, so it seems pretty clear how this potential policy change could redirect spending away from the traditional H-1B heavy models.
And towards those alternatives, domestic staffing, remote work platforms, nearshore providers, and even internal upskilling initiatives.
The analysis really draws a direct line from that proposed regulatory cost.
Straight to market expectations, that $100K fee acts like a lever, making those alternative models look better almost instantly, while putting, real financial strain on the firms built around the old H-1B cost structure.
It raises a final thought then. If policy risks suddenly become such a big factor in buying IT services, how does that change the homework companies need to do when they pick their tech partners for the long haul? That seems like the next big question here. Now, we need to be absolutely clear here. The opinions and the analysis we discussed today are based purely on the information from the author of the material we reviewed.
That's right. This is not financial advice. It's not a recommendation to buy or sell any stocks, including the ones we mentioned. Robert Half International, RHI, ManpowerGroup, MAN, Upwork, UPWK, Globant, GLOB, Coursera, COUR, Cognizant Technology Solutions, CTSH, Infosys, INFY, and Wipro, WIT.
Please, always do your own research before making any investment decisions.